Have you ever really stopped to wonder what a share in a company is? I mean, we hear the term all the time. Today, we're going to dive deep into its entire life story, from the moment it's born to raise money, all the way to the drama of what happens when things go wrong. So, let's get right into it.
So here's our game plan for today. We're starting with the absolute basics. What is share capital? Then we'll look at the two big players, equity and preference shares. After that, we'll walk through exactly how shares are issued, what happens when way too many people want them, and then we'll get into the juicy stuff. What happens when shareholders don't pay? We'll wrap it all up with the final step, forfeiture and reissue.
All right, first things first. Before a company can build anything, sell anything, or do, well, anything, it needs money. It needs capital. And for a huge number of companies, that capital comes from selling shares. So what on earth are we actually talking about here? Okay, imagine a company's total money pot, its capital, is one giant cake. A single share is just one equal slice of that cake. Simple as that. And the share capital, well, that's the whole cake itself. It's the total value a company is allowed to raise, just broken down into these nice, bite-sized pieces.
Now, this whole process works kind of like a funnel. At the very top, you have the authorized capital. That's the absolute maximum amount a company is legally allowed to raise. But what really truly matters is what comes out at the bottom, the paid-up capital. That's the actual cash in the bank that the company can use to grow the business. It's a journey from the theoretical maximum to what's offered, to what people apply for, and finally to what's actually paid.
But here's the thing, not all shares are created equal. Nope. Depending on the type of share you own, you could be a real decision maker with a vote, or you could be more of a quiet investor. Let's break down the two main types, equity and preference. And this, right here, is the fundamental trade-off. Equity shareholders, they're the real owners. They get the power, the voting rights, but they also take on the biggest risk. There's no guarantee they'll get a dividend. Now, preference shareholders, they trade that power for safety. They get a fixed payout, and they get their money back first if the company goes under. But they usually don't get a say in how the company is run. Power or safety? Which would you choose?
And just to make it interesting, preference shares come in a bunch of different flavors. For example, cumulative shares mean that if the company misses a dividend payment to you 1 year, it has to make it up to you later. It accumulates. And convertible shares are pretty cool. They give you the option to swap them for equity shares later on. See? Each type just tweaks that balance between risk and reward a little differently.
So, we know the types of shares, but how does a company actually get them into the hands of investors? Well, it's not a free-for-all. It's a very formal, step-by-step process. The process is actually pretty logical when you break it down. First, the company sends out an official invitation, called a prospectus. Then, the applications and the money start rolling in. After that, the company allots or distributes the shares, and finally, it calls for the rest of the payment, which is usually collected in a few installments. But, and this is a huge but, there's a critical safety net for everyone involved. It's the minimum subscription rule. A company has to get applications for at least 90% of the shares it's offering. If it falls short, the whole deal is off. All the money gets refunded. This is super important because it stops companies from trying to launch massive projects with barely any funding. It protects investors and keeps the market stable. Okay, so what happens when investor demand is just off the charts? Or what if a company wants to issue shares for more than their face value? Let's take a look at how companies handle these good problems to have. Now this chart, this is the dream scenario for a popular company. It's called oversubscription. They offer 10,000 shares, but the public is so hyped that they apply for 15,000. So now the company has to figure out, okay, who gets the shares?
The most common and fair solution is something called pro rata allotment. It's a fancy term that just means everyone gets a piece of the pie, proportionally. So in our example, for every 3 shares someone applied for, they might get allotted 2. It's all about being fair when you can't give everyone everything they asked for.
And what about when shares are issued at a premium, for more than their face value? That extra cash isn't just free money for the company to go wild with. The law is super strict here. That premium can only be used for very specific things, like issuing bonus shares to existing owners or covering the one-time cost of the whole share issue itself. It's all about protecting the company's financial foundation.
All right, now we're getting to the tricky part. The story isn't always smooth sailing. What happens when a company asks for an installment payment, but a shareholder just doesn't pay up? This is where a little bit of conflict enters our story.
So you have two completely opposite situations that can happen. On one side, you have calls in arrears. That's when a shareholder is behind on payments the company has asked for. But on the other side, you have calls in advance, where a super eager shareholder pays an installment before the company has even requested it.
As you might expect, there's a penalty for being late. Companies have the right to charge interest on any overdue payments, usually up to 10% per year. It's a pretty clear signal to pay what you owe on time.
But hey, on the flip side, paying early actually gets you a reward. The company has to pay you interest up to 12% per year on that advance payment, which is only fair, right? After all, they're getting to use your money ahead of schedule.
But what if a shareholder just flat out refuses to pay, even after reminders and interest charges? Well, that leads us to the final and by far the most dramatic stage of a share's life: forfeiture and reissue.
Forfeiture is the ultimate penalty for a shareholder. It's not just a fine. The company literally cancels their shares. Their ownership is gone. And the real kicker? They don't get back a single penny of the money they've already paid. It is a complete and total loss for them.
Now, a company can't just snatch shares away on a whim. There's a strict legal process. It starts with a formal warning, giving the shareholder one last chance to pay up. If they still don't, only then can the board of directors pass an official resolution to cancel the shares and wipe their name from the company's records.
But the story doesn't end there. Those forfeited shares aren't just destroyed. The company can turn around and reissue them to a brand new buyer. And here's the really clever part. The money the company kept from the first shareholder can be used to offer a discount to the new one, making the shares easier to sell. And if there's any profit left over after all that, it goes straight into a special account called the capital reserve. It's a pure capital gain for the company.
So, let's just quickly recap that entire journey. It all starts with a company issuing shares to get the funding it needs. Investors get excited and subscribe, sometimes way more than expected. If a shareholder can't make their payments, they face arrears and could ultimately have their shares forfeited. But even those forfeited shares get a second chance, reissued to a new owner, bringing the whole life cycle full circle.
So you see, a share isn't just a static piece of paper or a number on a screen. It's a dynamic thing with a real life of its own. We've seen how a company sells them to the public to grow, but that raises a really fascinating question. What happens when a company decides it wants to buy its own shares back from the market? Well, that's a story for another time.